In investing, you really want to find ands, not ors. So it's not necessarily it's common equity or preferred equity. That's the whole point of kind of diversification, is that there's benefits and there's drawbacks to both. And it's up to you kind of as a knowledgeable investor to say, hey, where's my investment strategy and what kind of equity aligns more with my long-term goals, with my risk appetite, my need for cash flow right now. And essentially what we're doing, we're just kind of outlining all the different options that are on the table, because we don't want to get you kind of siphoned into, hey, this is the only one way to do things. There's benefits and then there's deals that will work.
Hello, everyone, and welcome once again to the podcast. Today, as we often do, but we can never get enough of Mr. Nathan Loy, our Director of Strategic Planning and our Senior Analyst. Welcome, Nathan.
Thanks, Ravi.
Deciding whether to invest common or preferred equity into a multifamily syndication deal can be a confusing decision filled with risk-reward trade-offs. But properly structuring the capital stack is crucial to align interests and fuel win-to-win partnerships between sponsors and investors. In today's episode, we'll provide an in-depth look at common versus preferred equity, from their return profiles and risk exposures to real-world case studies. Whether targeting higher profits or lower risks, preferred and common equity both play integral yet distinct roles across the syndication landscape. Equip yourself to make informed choices by understanding exactly how these key funding sources differ. Okay, so let's go ahead and get started. And we can start with a simple question. What exactly is common equity in the context of real estate syndication?
Yeah, absolutely. So let's start off kind of what multifamily syndication is, right? When you talk about syndication, all it really means is you're pooling capital, you're pooling money from different people, right? It doesn't necessarily even have to be investors, right? You could pool money from your friends, your family. Really, it's kind of anybody and everybody. That's kind of syndication as a whole. When we're talking about multifamily syndication, what we're doing is we're pooling money typically from investors to then invest and purchase a multifamily asset. And typically how kind of common equity works into play is that not all equity is treated equally, especially when we're talking about real estate and specifically when we're talking about multifamily. So when you go to purchase, a single family home, for example, you typically have a loan that covers a portion of the purchase price, and then you come in with, what's considered a down payment. The same's true on a multifamily deal, but at a larger scale. So you'll have to cover some of the closing costs and some of your renovation budget, but ultimately common equity comes in and it's that gap between your total project cost and what the loan will cover. That's kind of where the common equity comes into play. Most people are most familiar with are kind of the terms investors. Those are typically the people that are falling in that kind of common equity space. So in multifamily syndication, you have general partners, which are the GPs. Those are typically the main sponsors of the deal. They kind of own and operate the deal, and they'll pool capital, they'll pool money, typically at acquisition from investors to then purchase the property. And in return, those investors, called limited partners, get a preferred return. So they get a certain interest on the money that they invested, as well as taking part in kind of profit shares once you go to sell the property or go to refinance the property. There's a whole kind of bunch of different structures, but that's kind of where it breaks down simplistically between common equity on one end, and then we'll get to preferred equity later on in the discussion.
Yeah, so this is what we call a capital stack, right? So what the capital stack is basically the stack of money you have in funding the deal. So how are you going to do it? How are you going to divide it up? The first part of the capital stack is usually debt, and that's low interest rate compared to the rest typically. The reason that you can do these deals and make a decent amount of profit often is because you have low cost debt, and you can leverage that debt on the investment and get higher returns that way. So then after that debt, what Nathan was talking about was common equity, which is limited partner equity, and that fills the remainder of that capital stack up to the point of the total cost needed to close on that particular acquisition. So you've got two things here in the stack. You got debt payments, and then you got LP or common equity. So now we're going to add a third one to that, which is preferred equity. Preferred equity sits right on top of debt, is senior to the LP equity. So it's in a better place in the capital stack. Where you are in the capital stack is how you get paid. Like if you get, we call it a waterfall. The money flows to debt first, because debt always gets paid before your limited partners, and then to preferred equity, and then to common equity. So Nathan, what is preferred equity then?
Yeah, absolutely. So kind of to your point, Ravi, preferred equity comes in and it's kind of that placeholder between your common equity and your debt. So typically most loans are constrained on a few different metrics, one of them being loan to value, other metrics being, DSCR, That's a debt service coverage ratio, how much income the property can produce relative to the debt service. So these loans have certain tests that they need to meet, and that's going to constrain the proceeds that they can give to any one project. So oftentimes, again, you have that gap between the common equity then and kind of the total cost of the project. And that's kind of where the preferred equity groups come into play. You can kind of think of them as institutional private firms. So if you think about family offices, for example, they typically come in as preferred equity. And they sit right behind debt. So debt gets paid first, and then the preferred equity groups get paid second, and then the rest of the waterfall flows down to the investors and then ultimately to the owners. But what's important to note for pref equity is that they have, not only do they sit kind of above common equity, they sit kind of in first position before investors, but they also have some other privileges given that they typically invest, pretty large sums of capital, right? Anywhere between 5, 15, sometimes even $20 million checks. They also have the ability to take over the asset too, which is more similar to debt than it is to common equity. So if you miss your debt payments, for example, they can, do a lender for sale, they can foreclose on the property. There's a whole bunch of different avenues they can take. And the same is true on the pref equity side of things, where if you're not meeting the certain pref equity payments, they can come in and take ownership over the asset and really kind of start controlling the asset. So one thing to note on the pref equity side of things is that it's not, well, in terms of how they get paid, it's not necessarily like debt where it has to all be paid current, right? Like if you have, call it a 7% interest rate on your debt, you pretty much have to meet that interest rate, right? There isn't, hey, I'm only going to meet 3.5% interest rate and I'll make up the other 3%, right? It doesn't happen on the debt side of things. That can happen on the common equity side of things, right? There's been times where, hey, throughout the hold period, we'll offer you a 7% preferred return on your money. But during the first kind of few years while we're doing the value add, while we're renovating, you can probably, expect 4 to 5%, and you'll be caught up at the end of the project to your 7% and made whole, right? The same is true on the pref equity side of things. So they often have kind of a current payment. So what you must meet on a monthly or annual basis, and then they have kind of an all-in payment. So that's the total amount that they want kind of annualized throughout the hold period. So they might say, hey, you can pay us an 8% current, but we want a 12% all-in rate, meaning that by the time you go to take the pref equity out of the deal, whether that's through a refinance or through a sale, that they'll at least have made 12%, every year on their money. So it's kind of that perfect blend between, again, the investors and kind of the debt. It sits perfectly right in the middle there.
Yeah. So what's really interesting, especially now with the market changes, is that you as LP investors can actually get involved in a preferred equity position. That has not necessarily always been the case. It hasn't been as easy to do that, just because the leverage on some of these deals has been so high with low interest rates, in the past, that there's no need for pref equity. You could fill it up with common equity. As Nathan, as you mentioned, the benefit of common equity is that you're leveraging the debt, so you're able to potentially make huge gains. But then also, if something goes south, you're going to take the hit. You're going to be the first one to, take a loss, and then debt's going to be after you. So with the preferred piece, you're taking less risk, and potentially you're getting some gains. You're in a really good spot. So Nathan, maybe we could just talk about the risks and the benefits of common versus preferred equity.
Yeah, absolutely. So one of the kind of benefits again to preferred equity is that you are, I would say, more guaranteed your payment. Nothing's really guaranteed in investing, right? We all kind of know that. But you're more guaranteed because you sit in that first position. You don't take part in kind of the profit upside that the kind of common equity investors take on, but you do kind of have a guaranteed, interest rate on your investment that's higher than what you're offering your common equity piece. Kind of some of the risks of solely relying on common equity, right? Because you might say, hey, if there is a gap between the loan and kind of my all-in cost, why don't I just fill that totally with my common equity, with my investors, and kind of go the more kind of traditional syndication route, right? The problem with solely relying on common equity is that group has higher exposure during market fluctuations, right? So if it's completely filled with common equity and you only have your debt and your common equity, and the property doesn't cash flow, right? That can have a more substantial impact if it's just common equity, right? But if you have that pref equity piece that's kind of slotted in there, there's more kind of optionality for the deal as a whole to perform well. So there's also less protection for LP capital compared to pref equity, right? So if you're thinking, hey, if I'm just focused on capital preservation, I don't really care about upside. I just don't want my capital to be eaten away at inflation at 3, 4, 5, 6%. That pref equity piece can be a really kind of smart, solid, safer investment than going kind of the full common equity route. And lastly, common equity is the most expensive form of capital, right? If you think of debt, you just pay the interest rate, right? And you start to probably amortize in the debt. If you think about pref equity, you have probably a high interest rate that you're paying, but there's no profit splits. But when it comes to common equity and those LP investors, they take their preferred return and they take part in some of the profit splits at the end. So if you can kind of mitigate the amount of equity that's invested on the common equity side of things, you actually do a better service to your investors because they can take part in higher bonus appreciation because there's probably going to be a lesser amount of investors if you do have pref equity involved in the deal in some sense too. And then lastly, if you do kind of the full common equity route and you don't have any debt or any pref equity whatsoever, you're not really leveraging that capital to its highest ability, right? You want a nice balance where you can leverage the deal with a low cost of capital with debt, but still be able to cash flow, still be able to meet debt service, still have cash flow left over to pay either the pref equity group or to pay your investors. So there's kind of pros and cons to each side. It just depends on whether you want to really take part in the tremendous opportunity of potential sales and kind of profits at the back end, or if you're more concerned with preserving your capital and want kind of a more guaranteed payment, then you'd probably go the pref equity or even the debt route at that point.
Yeah, so there's different ways to look at this. You're looking at it from a sponsor's perspective. So, as Viking Capital, we're sponsoring a deal. How do we want to fill the capital stack? Do we want to fill it with, we're always going to use debt, but after debt, how do we want to fill the capital stack? And the way we think about it is, whatever is the least expensive capital to fill it with, we'll want to do that, which obviously makes sense because if it's the least expensive capital, it's the best returns for us. It's the best, maybe the best returns for not the best returns for the investor. It's the best returns for the sponsor as a whole. But that's what we would want. Now, if pref is cheaper, because maybe it's like a fixed 8%, that's all they're charging. And we're looking at this deal, we're like, well, hey, the LP investors are going to get 20% average annualized return after 5 years. The pref is only going to get fixed 8. Yeah, then we'll certainly do pref. But if the pref is if the pref has onerous terms, like if they're like, look, you do not give us our 8%, and usually it's like 8% plus some back end percentage, like maybe 4%, let's just say. So 8% up front, 4% in the back. If you do not continuously give us our 8% current, then we have the right to take over the deal. We have the right to force a sale. We have the right to put the cash in, lockbox or something like that. And by a lockbox, I mean like create a cash management system so that we don't have control over it. They have control. Sometimes you have pref partners that put these terms in place. Then it might not make sense to take that cash because you're like, well, look, it's cheaper, but at the same time, I'm taking a risk. And if someone goes down with the property, and I can't pay these guys, then they're going to take over. They're going to sell it. And I don't want to do that. So there's like different ways to look at it from a sponsor's perspective. If you are a investor and you are looking to invest as an LP or a pref equity partner, that's where it becomes very interesting because, as I mentioned before, you couldn't necessarily do that before, but now there's becoming these vehicles available where you can invest as a pref equity partner. And for me, I'm very conservative as an investor, also as a sponsor. But if, in my conservative nature, I would take that pref position often over a common equity position because, as we discussed, you have a preferential position for getting your money. So like, say you just have enough to fill the debt and plus half of the capital stack after that, the remaining capital stack, then you will get, as a pref partner, you'll get your money. As a common equity partner, you may not. They may pause distributions. but you can structure it so that you're getting paid. If something goes down with the deal, then you could potentially take a GP position, sometimes even in another deal. There's some structures out there where you take GP not only in that particular deal, but maybe even another deal to mitigate risk. So if you are looking for risk mitigation, if you're looking for just cash flow, a lot of cash flow up front, you're looking to be in a better position than the LP investors, then think about that. And this really comes into practice, or it comes into play rather now. We're recording this at the beginning of December 2023. At this time, there are a lot of groups looking for this pref equity because they're refinancing. They're looking to restructure their debt because their loans are maturing. They need options. The way it's working now is debt isn't it can't fill the capital stack as much as it did previously. Values have dropped, so the LTV is dropping. You can't fill it, so you're looking for someone to fill that gap, and that's where these pref people come in. And that's as an investor, really think about that as a interesting investment.
Yeah, you could come in and kind of what we call recapping the deal or recapitalizing the deal. Essentially, what that means is a new group of investors comes in and replaces the old group of investors, right? Essentially, you're swapping out common equity. But if it's already a distressed deal, right, the risk of replacing your investors, the worst that happens is you lose your investment, right? But then you're kind of, I'm not going to say dead in the water, but then you don't have much optionality outside of that. But if you come in as a pref, equity in a distressed deal, if the property isn't performing it to what it's supposed to be, it's not cash flowing, you then have the power then again to take over the property and kind of control operations. So it's a little bit more of a safety net in kind of the worst case scenario situation.
Yeah. So Nathan, we spoke about what common equity is, what pref equity is. We spoke about some of the risks and benefits of each. What other factors should be considered when let's look at it from a investor's perspective, not necessarily sponsors, but what other factors should an investor look at to determine whether they should take a common or preferred equity position?
Yeah, it's a great question. Really what it comes down to is what are your kind of investment goals with the capital you're investing, right? If it's, as to your point, Ravi, if it's a more kind of conservative capital preservation play, that pref equity slot might make the most sense, right? It's somewhat similar to our, what we call Class A, which is, as close as you can get to guaranteed cash flow. If, on the other hand, you are looking for greater upside, you don't necessarily need immediate cash flow, and you want to, bank on appreciation play and kind of, hey, this has a great value add story and there's more profits to be taken at the back end. That's a phenomenal bet too, right? The other kind of thing I would consider is the hold period, right? Typically, most pref equity groups come in and they want to be out of the deal in 2, 3, 4 years, typically through a refinance or through a sale. So if you're looking for kind of a quick turn on your money, pref equity might make a lot of sense. There is this one deal that we recently did where we did a loan assumption, meaning that the loan to value wasn't as high as kind of market standards. And so we came in as pref equity, knowing that in year 2 or 3 of the project, we're going to have to refinance, take the debt out, probably take some of the pref equity out too, in which case that would return some of the capital to that pref equity group. So if you're looking for a quick turnaround on your money, go the pref equity route. If you're more focused on kind of long-term wealth building and are more focused on appreciation, I'd go probably the common equity route. And then the last distinction, it comes down to kind of the tax benefits, right? Most pref equity groups, I'm not going to say all because there are some that definitely do, but most pref equity groups won't take part or at least a large chunk in the bonus depreciation, which leaves the majority of that for the common equity investors. So if you're really focused on those tax benefits and really maximizing the depreciation, especially as it's stepping down over the next few years, then I'd go the common equity route because the pref equity groups typically don't take part in that depreciation.
Yeah, that's a great answer, Nathan. And for I'll just give you a more of a real world example from what I'm seeing is that right now, again, end of December or the beginning of December 2023, and how I foresee things going into 2024. And I did a podcast with John Chang just recently. Hopefully we'll publish that soon, maybe even before this one. But if you haven't listened to that, please do. He gives a lot of good information about the market and how he sees it in the next several months. But what I see is cost basis are very low for apartment complexes right now. Even in fact, I was talking to a broker yesterday who said that there was a unit or a complex rather, that's coming up for sale that used to be $180K per unit. So that was the broker opinion of value, the BOV. That one was $180K about a year and a half ago per unit. The seller didn't sell because they didn't implement their full business plan. Right now it's $108 per unit. So that's a massive drop. And this is close, in Atlanta. But the seller needs to sell. They're finishing the life cycle of their fund, and they're motivated. So they want to sell at such a low cost basis. People that are selling now for those reasons. They have, their funds are going to mature. Maybe their loans are maturing. Maybe they bought the property 5, 8, 10 years ago, and they're already making nice profits. They want to sell. Maybe they're forced into selling, but they're selling for a low cost basis, and a common equity investor at that time is a really strong position to be in. So I would say definitely invest in those deals. At the same time, there are other deals that are being refinanced that were purchased for a much higher amount, and they're being refinanced, and they're trying to maintain that equity, that capital stack with preferred equity, and you can potentially invest in that through sponsors. I would be a bit more cautious about that. I've seen a lot of those come across the table, but be a bit cautious in the respect that you have to make sure the sponsor knows what they're doing and they're investing in the right deals. Because if you start just throwing pref equity around into a deal that's maybe not doing well, the whole deal could tank and you could lose that money if it's not structured properly. But if it's tied to like other GP, if it's tied to something else, maybe you're hedging your bets, but you have to make sure the sponsor knows what they're doing. So, but that is also a really solid investment. We always talk about diversification, Nathan. We always talk about kind of splitting your investment amongst different types of assets. But this is something I would split. I'll do a little bit of both.
Yep, absolutely. And that's the thing, right? It is pref equity makes a lot of sense, especially if there's future upside to be had, right? A lot of the deals that we're seeing right now, in the market, are distressed predominantly through their debt service, right? Their ability to meet rising debt costs. But if you can come in at a refinance, right? Because if it's just a debt service issue and the property's performing well, it's hitting, its NOI projections, that's actually not a bad place to be in, right? If you go to refinance, you can kind of stabilize that debt and then come in with, pref equity directly behind that. That can be a nice, gap to bridge, especially when you have future upside too. If there's a lot of kind of value add left in the property, that should hopefully translate to future cash flows as well. And especially if the properties are performing well and then you stabilize the debt, the property, there are properties out there, there are deals out there that will work with debt, with pref equity, and then with the common equity investors as well.
Absolutely. Nathan, any more examples that you want to share with us that gives people an understanding of pref and common equity?
Yeah, I think if you look at most deals right now, I just saw this this news headline of another syndicator that kind of went belly up with $130 million of loans that can be paid back. If you're a common equity investor in that scenario, it's not a bright outlook, right? You're pretty much losing all of your investment. On the flip side, I've seen some deals that have been held for 2.5, 3 years and produced a 20, 25 average annualized return on your money. So there's tremendous upside in that sense too, right? But it all really just depends on what you're focused on, because not all deals are going to perform equally. And so whether you're going on the common equity side of things or you're going on the pref equity side of things, what's paramount is kind of the cash flow, right? And then the ability to sell and kind of the whole valuation further down the road. But ultimately, specifically for pref equity, you want to make sure that the property cash flows. And so those deals that have pref equity that really make sense are those and to be honest, most of them I've seen during loan assumptions or during refis, where the loan doesn't cover high enough leverage. You come in with pref equity, you go to refinance, you take some of the portion out of you pretty much return all of the loan, you return maybe half the pref equity, and now that you've really kind of leveraged that capital during the start of the project, and now you can kind of have more reliable cash flow moving forward. That's really where it makes the most sense.
That deal that tanked, was that an office?
No, it wasn't. It was a newer syndicator who was investing in multifamily as well.
Okay. Yeah. So I think that another thing to add to this is vet your sponsor. Because somebody that's newer or less experienced, doesn't have a track record, or invests in, office, which is, going down a lot. It's having there's a lot of difficulty in the office space. There's a high chance that you're going to not do well. If you're investing in a sponsor that like, and trust, you have experience with, that has a track record, that's when you're more sure that you're going to do well. So that's a huge component in there. Cash is always king. You always want to make sure you're cash flowing. If you trust your sponsor, they will make sure of that as well, especially in a preferred equity position. What happens a lot is when you invest in pref equity, it may be that the common equity doesn't get any cash flow, but the preferred equity does in a given deal, because they have to, they're restructuring it, they're paying the debt, they're paying the pref, they're continuing their business plan, increasing rents, the same type of business plan that we typically implement. It's just taking longer because of the economic cycle. But once you go through the rent roll, renovate, you start getting more funds, then they start paying the common equity again. But if you're in the preferred equity position, you're getting paid that whole time. So, really, it's opportunistic investment, and it's helpful for people. It's not just like you're being a vulture and trying to take from folks. You're getting more, but you are helping them maintain the deal.
Yeah. And I think it's important what you said to, really know the sponsor. One kind of comparison that I didn't make between common equity and preferred equity is that typically when you involve preferred equity, they're seen as a partner in the deal. So they're going to be underwritten by the lender, almost as a sponsor will be. So they are kind of a true partner, when the same is not necessarily the case for common equity investors. Those individuals or those groups typically aren't underwritten the same kind of scrutiny as the pref equity people are. So if you do have a deal that you're investing in that has pref equity, and you're more on the common equity side of things, just make sure that you fully understand, why the pref equity is coming in, who they are, what the track record is. Because again, they're going to be kind of a major partner alongside the main sponsor in the deal as well.
Excellent. Well, Nathan, we had a great discussion here about common and pref equity. Before we conclude, any takeaways you want to give our investors?
Yeah. I mean, to kind of how we started the conversation, right? It's in investing, you really want to find ands, not ors, right? So it's not necessarily it's common equity or preferred equity. That's the whole point of kind of diversification, is that there's benefits and there's drawbacks to both. And it's up to you kind of as a knowledgeable investor to say, hey, where's my investment strategy, and what kind of equity aligns more with my long-term goals, with my risk appetite, with my need for cash flow right now. And essentially what we're doing, we're just kind of outlining all the different options that are on the table, because we don't want to get you kind of siphoned into, hey, this is the only one way to do things. There's benefits, and then there's deals that will work both on the pref equity side of things, on the common equity side of things, on both, on neither. So hopefully this kind of is a really educational talk. There's really kind of relevance to discussing now, because there are a ton of groups that are going the pref equity route and a ton of deals that are distressed. I think it's a really timely discussion.
Yeah. This is a very opportunistic time to invest in both positions. If you ever have any questions about a particular investment, any deal, hit us up, hit our investor relations team up, and even talk about other deals. We're happy to go over our deals, other syndicated deals, pref equity positions. We can give you another perspective. Happy to do that. As always, feel free to contact us. So thank you, Nathan. Really enjoyed this discussion, and please stay tuned for our next episode.
Always, Ravi. Thanks so much.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.